maximize, like, who wouldn't want to maximize your tax strategies, right? A lot of people want to make a difference in the world. And, a lot of people who are wealthier, I think many people feel an obligation to kind of give back, if you will. And wouldn't it be nice to pay less taxes and do the same thing and get this sort of tax benefit? And as you'll see, and Christina's going to go over this material, a lot of this stuff just kind of falls off the turnip truck in the sense of, if you just order the sequence or pay out of different buckets, you pay less income tax overall. And these are just, a lot of this is kind of basic tax hygiene that we've talked about in the past. But if you're a donor, if you're giving to charity, there is the ability to take advantage of income tax benefits to reduce your overall tax benefit. I'm Jim Cunningham. I'm a partner at Cunningham Legal, over 25 years experience. I'm a certified specialist in estate planning, trust, and probate law, as well as a real estate broker, securities insurance license, and a pilot. Hi, this is Jim Cunningham. Today, we're going to talk about maximizing your tax savings with charitable giving. I have Christina Lindsay Orta, a certified financial planner, with me and frequent flyer on our Cunningham Legal YouTube page. If you're watching this on YouTube, these are the 13 lawyers we currently have in our firm. They're all dedicated to creating and preserving multi-generational wealth. This is a team of certified financial planners at Ascent Wealth Management. We have Christina, Alyssa, Shannon, and Christina's father, John Lindsay, who is founded Lindsay & Lindsay with Christina. And Christina, I will let you talk about this disclosure. This is actually a very important disclosure. If you can maybe take some time, for those of you who are watching this live or on YouTube, take some time to take a look at this.
Yeah, this is just our standard disclosure that we are licensed certified financial planners. We're licensed both with the SEC and with FINRA. And so everything on here is not advice. We would only give advice when we're doing a one-on-one engagement with an existing client or have entered a financial planning engagement. So please acknowledge that this is not any particular direct advice or recommendation of any security or strategy.
And this is my disclaimer, which is I'm a lawyer. I'm talking. This is not legal advice. When I say you, it's like watching Shark Tank and they say, yes, I'll give you $2 million for your business. They're not talking to you when you're watching it. They're talking to the contestant. So in other words, don't watch this, go out and do a bunch of stuff. You absolutely should get competent legal and tax and financial planning advice on this. I will tell you, Christine, this is actually really important because I know when you and I do charitable planning together with clients, it necessarily involves the CPA and we run multiple math calculations. So this is like a measure 19 times and cut once. If you're watching this on YouTube, please subscribe to our YouTube channel. You can click the little bell and you get alerted when our content is posted on YouTube, typically Pacific time around 6 p.m. So Christina, I'll let you take it from here. So why give it all? Why do people give to charity? Tell me what's going on.
Well, I tell people giving to charity could be, some people are truly charitably inclined. And, giving to charity could be giving of your time, treasures, talents, and it could be a number of different things. And so sometimes it's simply just that there are important causes to you. Maybe you came from a charitable background. Maybe someone, did something for you charitably over your lifetime or give you that hand up. And so it is an important thing for many of our clients to do charitable giving. And then the other way, really is tax mitigation. How you're either going to give if you make a lot of money or you have a lot of income earnings or a lot of growth in your wealth, you're going to be paying your fair share in taxes. It's either going to be in state taxes or to Uncle Sam. So, rather than giving to the government and then having them take their dice and maybe some getting to your ultimate cause, it may or may not even be a cause that you agree with. And so that's really where a lot of clients go, well, if I'm going to be giving anyways, is there a better way to control what's important to me, where those funds go, rather than giving to the government? So that's really another strategy too. Some people are simply doing it for tax mitigation purposes. And then there's also those that are they care about the causes.
Yeah, I was talking to my parents. My dad turned 80 a few days ago, and I visited him and my mom in Texas, and we're driving, and he said, my dad went to law school at University of San Diego many years ago, because these numbers matter. He said to my mom, do you remember we got that scholarship for $700, and they still talk about it. Like $700 for those of you watching was a lot of money back in the 60s. Okay. but he still talks about that. And so if you're on the donor side, if you're on the giving side, you should know that this impacts people directly for the remainder of their lifetime, and really can be a tremendous blessing to both the people who are giving and the people who are receiving.
And one of the things also, is our hospitals. Most hospitals in the United States were started from some sort of charitable cause. A lot of the education universities as well, but in particular, most hospitals are run or started or founded as charities. So, charitable giving is a big component of the American fabric in the United States. So, income tax is a huge reason why to give. And if we look at our tax system, which is a progressive tax system, these are the tax brackets, and this doesn't include state tax. And so, I'd say a larger percentage of Californians are between state and federal paying over 40% in taxes.
And an effective tax rate, by the way. So what we're talking about here is the effective tax rate. So if you make about 882,000, your effective tax rate is 29.7. Federal, it's graduated tax. Now, if as you earn more income, that number, of course, goes up. So the marginal rates would be the highest rate. But even if you're in $1 million, on some of that money that you're earning, that will be taxed at a lower rate. And as you earn money, it's taxed at a higher rate. It's also really important to understand there's something called worst first, meaning if you make a charitable contribution of $100,000 and you take that deduction, it's coming off the marginal, the top tax rate, not your blended or your effective tax rate. So charitable planning comes off the top. And what we look at is your kind of overall tax rate. And that does bring your overall taxes down if you can kind of knock out that marginal tax bracket.
Mm-hmm. And so the income tax brackets, they do adjust over time. They typically are modified for inflation, and we do see those published and come out each year. But they're also going to revert and sunset at the end of 2025. So come 2026 tax year, if Congress does nothing, the taxes are going up back to what they were prior to 2018. So the federal highest tax bracket would be 39% as opposed to 37%. So these are what those tax rates are expected to be, certainly going up on the higher end.
Yeah, so just think in 2026, this is what happens with taxes. Right.
That is very true. And along with that, you have estate taxes that we're being mindful of. So estate taxes, that is, something that is taxed at 40% right now on anything over the exemption. So Jim, I know you deal with a lot of this in your world, but the current exemption is almost 26 million that a couple can pass on. So a married couple can pass on 26 million. Now, key thing, this doesn't apply to, we've had a lot of people that we've met with recently that are partners or are not legally married. And so if there's no legal marriage in the United States, the IRS tax code does not allow you to use the unused exemption of your partner, even if it's a domestic partner. It has to be a married spouse. And so that married combined exemption is almost 26 million. And anything above and beyond that is taxed at 40%. That's also supposed to sunset in 2026, where it's going to go down to 6.5 million per person. And anything over that also taxed at a higher rate. So something to be mindful of in our planning as we're meeting with clients. This is something that we're certainly keeping a very close eye on, which is also a reason to look at doing charitable giving. It's not just an income tax play, it's an estate tax reduction play. So there are ways to control how you make sure that that is not going to tax to the government, but going to causes that are important to you, and potentially also getting more to your family, yourself, your family, or your heirs. And so there are many purposes for doing types of charitable giving, estate tax being one of them. There are different types of charities to give to. Jim, you want to talk about public-private?
Yeah. So a public charity is going to be like, American Red Cross. It's going to be maybe your local hospital. Shriners, it's another great public charity. Many universities and schools are considered public charity. And, again, Much of the educational system in the United States and the healthcare system in the United States is supported through charitable dollars. And the rules are different on deduction. So if you make a deduction to a public charity, you can deduct up to 60% of your income if it is cash. If you make a contribution or deduct a contribution of appreciated assets, then there are different rules apply, and that's capped at 30%. So if I have Apple stock that has zero basis and it's $100,000 and I make $1 million a year, I can take a full deduction. If I make $100,000 a year and I make that Apple stock gift of $100,000, I'm limited to $30,000 deduction. Now that other 70 does carry forward to future years, but bear in mind that there is a difference in the cost basis. So cost basis is what you buy, what you pay for something. Market value is what it's worth. You can take a deduction for up to 60% of market value of cash, which cash is its basis, right? But if you have this appreciated asset, you're going to be capped. Now, those rules change from year to year, and they were more generous in prior years, and the government's throttled those back a little bit. Family foundations, corporate sponsored entities are under a different set of rules, and then you've got a 30% cash and 20% capital gains limitation. So many times, if you watch public television, a lot of times these are private foundations that fund public television. Just know that, you can give more. You're just not going to get that deduction this year. So again, the Apple stock example of $100,000, if you make $1 million, yeah, you're going to be fine. You're going to take a deduction. But if you make 100,000, that might be a 20% deduction every year, maybe for 5 years. So just be mindful of the values of the assets that are going in and whether it's a public or a private charity. So the rules are different.
This is kind of what we just touched on as far as, the charitable deduction. And it really is a function of your income, your taxable income, what your income sources are your income sources, business sources, W-2 wages, investment income, is it passive income, active income? So this is really where we kind of go back to that one thing that we always speak about is the three-legged stool, is, making sure that we're giving the right assets and making sure that we're doing so with the right vision in mind. Is this geared towards mitigating a future estate tax? Is this geared towards mitigating income tax? Is it both? And how is that deduction going to be maximized for the end client? So depending on all your different income sources, your individualized situation, these deductions are not the same across the board. So we do want to make sure that we make mention of that. But looking at a very basic case, sometimes we deal with a lot of clients that are taking the standard deduction, especially due to SALT, which is the state and local income tax deduction cap, to where you're capped on how much state income taxes you can deduct on your income tax return due to the Tax Cuts and Jobs Act of 2018. And so with more people taking the standard deduction, they may be giving to charities each year. They might give quite a bit charitably. But this is an example to where it is better to bunch those donations as opposed to giving each year. So in this example, if we were to look at someone over the course of 2022 and 2023, and we know that they've got 20,000 available to give, they did 10,000 in each year. And they might have other deductions, their property taxes and other deductions of 13,000. Well, their total was 23,000 each year in option one, meaning that the standard deduction for each of those tax years was greater. So anytime that the standard deduction is greater than your itemized list of deductions, you simply file with the standard deduction. And a lot of times clients have a hard time grasping this too. I've got some retirees where they might have significant wealth, but they don't have significant income. And as they're taking that income and they're still giving to their, charities of their cause, and they're, keeping those receipts, and they're like, well, why can't I, why am I not getting credit for all of these deductions? Why I'm giving, quite a bit of money. And it's because the standard deduction is greater. And so that's really where looking at other ways to give, bunching of them being one of them. So rather than giving $10,000 over the course of 2 calendar years, if you were to give $20,000 in 1 calendar year, that would then mean your deduction is greater than the standard deduction. So in this particular case, in 2022, in option 2, that $33,000 in 2022, you take that $33,000 deduction. And then in 2023, you take the standard deduction. So you're getting an additional $7,100 in additional tax deductions. And so that is more tax efficient. And people go, well, what if I don't, what if the charity, I've just done an annual giving commitment. I've done an annual giving commitment, because a lot of charities have people that do systematic giving. They give every month or every year. They rely on those continuous gifts. A way to do that would be through a donor advised fund, which we're going to talk about as well, to where you can give that entire $20,000 to a donor advised fund, get the tax deduction in that calendar year, but have the donor advised fund give to the charity in future years. Yeah. So we'll talk about that in a little bit greater detail, but that's the way to maximize the deduction.
Yeah. And stated another way, you can commit to those funds going to a charity and put it in a special account, but the charity doesn't get that money yet. Now, certainly if you give it to the charity and say, look, I'm preloading my, 3 years of gifting, but a lot of people, to your point, Christina, a lot of people, whether it's a religious institution or institution of higher learning, typically they like to do that monthly giving or that annual giving. So correct. What to give? I'm going to start with what not to give. S corporation stock is problematic, right? When it comes to charitable trust, just know that out of the gate. So we talk a lot about corporations on other videos, but giving S corporation stock in to a charity is a bad idea. Okay, so just by and large is not a good idea. Appreciated stock. So for example, I buy Apple I buy $1,000 worth of Apple. It's now worth $100,000. If I give that Apple stock, I can turn around and buy $100,000 of Apple stock. Now, why would I do that? Well, I've just eliminated a capital gain, right, on that Apple stock. So I give $100,000 in Apple stock away. I can turn around and buy that stock on the open market. I still own Apple stock, but my basis now has gone from 1,000 to 100,000, and that saves me capital gains. Talk about part of a portfolio rebalancing and trim outperforming names. Walk us through that a little bit.
Yeah. So one of the things that we wouldn't want to do is giving a stock that is trading at a loss. So, Disney's a famous one to pick on right now because Disney's just taken it in the shorts. And so, a lot of times people go, well, I just kind of want to get this out of my portfolio, or I want to give this stock. This stock isn't important to me. But from a tax perspective, you don't want to give a stock that's trading at a loss. And the reason being is you can actually sell it, take the loss, use that to offset some other stocks that might have gains. And that's what we call tax loss harvesting, is selling some stock for a loss, some stock for a gain, so that you neutral them out and you're able to rebalance your portfolio without having a tax implication. And then do your giving from something that's highly appreciated. And we'll kind of give this example here of giving from a highly appreciated stock. You're then going to be able to give more to the charity and get a greater deduction for it without having to recognize the capital gain. So I think in this next slide, we have an example of that, where this is just showing if we were to sell the stock. So let's just show a stock that has a $50,000 fair market value. And if the cost originally, let's just say that we bought a particular XYZ stock for $5,000, it's grown by $45,000. And it's now today worth $50,000. And if you own this, we're talking about outside of an IRA, so in a non-qualified taxable account, if you were to sell this and you've held it for a year and a day, 12 months and a day, it would be treated as long-term capital gains. And the long-term capital gains rate at least is 15%, sorry. Depending on your income, it could be 20%. And then you add the Affordable Care Act tax on top of it, it's really 18.8% or 23.8%. But let's just use 15 in this example, not counting state tax that gets tacked onto it. You've got a sale of $50,000, recognizing a $45,000 gain. If you sold it, you would then pay tax federally, not including your state tax, of $6,750. Then you would give less to the charity, and the charity would end up getting less, and your tax savings is really only about $3,630. If you were to give the entire $50,000 worth of shares, You can just give it to most public charities, some private, but most charities can receive that stock. As long as they have an account, you can have it go directly to the charity. And they can receive those shares. A lot of churches do too. Churches, education, small institutions that you would think, well, they're not a big charity, but as long as they're able to have an account to receive those shares, people can do their gifting through shares. If you give that entire $50,000 to the charity, they get an additional $6,750. So it's better for the charity. They have more capital at their disposal, and you get an additional tax savings because you have a higher deduction.
So what you're saying is sell the losers and give away the winners.
Correct.
All right.
Yep.
Sell the losers, give away the winners. Because if you do it the other way around, you end up paying more tax.
Correct.
Donor advised fund.
Yeah.
There is something called the Community Foundation, and this was passed in the Tax Act of 1969. So in the way back, going back to the Nixon administration. And what that's about is federal legislation that said, you know what, it would be a really good idea for communities, and so this is geographically based, for these, typically they're a county, and Los Angeles County, they're called the California Community Foundation, I think, because they were first. But these are typically geographically based organizations that are receivers of assets, and then they in turn distribute those to charitable organizations. And you might think, well, why not just give to the charity? Well, one reason is this donor advised fund. And Christina, do you want to explain what a donor advised fund is for the people who might not know?
Yeah. And I know you talked about some community organized donor advised funds, but a lot of times, most of our clients will create their own donor advised fund to where it might be held at Fidelity or Schwab, and we can help them establish those accounts to where they don't have to give it completely, they don't have to give up complete control. So they can have control to an extent over those funds. It can be one that they oversee the management of, maybe with the help of their financial advisor. And we can create an account with as little typically as $10,000. And the funds go into a donor advised fund, which is a particular designated account. Now, once the donor funds go into that donor advised fund, you cannot take any funds back out for your own benefit. They're gifted. You're taking that tax deduction. They are now, might as well have been seen as given to a charity directly. Those are in an account. They can be invested. They can grow. We've got some clients that'll put $100,000 in a donor advised fund. They'll let it grow every year, and they'll give, $5,000 here, $5,000 there over time. But that fund can grow. There's no annual requirement to have money get distributed out to charity. However, any distribution that comes out of that fund does have to go to a 501c3.
That's a specific type of charity, right? That's
correct. A public charity.
People think of as a charity, right? The American Red Cross, sort of the Shriners, those are 501c3.
Yep, exactly. So the donor still has and maintains control over when and how much those gifts go out of that fund, but they could stay invested. Let's just say that it's a 2022, the stock market is, really doing poorly. Let's wait for those funds to come back up and regain some account balances to be able to do more maximized giving. And that's where the donor does retain the control over how those funds are invested and when they're gifted. So a charitable trust, there are different types of charitable trusts. There's remainder trusts. If we really simplify this, there are two types of charitable trusts. There's a remainder trust and a lead trust. And the primary difference between the two is that if there's a remainder beneficiary, that's the charity, that means there's a benefit to someone during their lifetime, whether it be the donor or whether it be another income beneficiary. It could be a child, a spouse, a friend, but typically there's someone that's getting an income benefit from that gift during their lifetime. And then upon passing of the donor, the remainder beneficiary is the charity. So for all simplicity purposes, there's all different kinds of charitable remainder trusts. You're going to hear lots of different terms sometimes. You'll Google all different kinds of trusts that exist, but there's really two primary types. It's a remainder trust or a lead trust. In the lead trust format, the charity takes the lead. So we have maybe some younger clients that don't need funds right now. They may gift to, we've got an example of a client that gifted to Penn State. They did a huge charitable gift to a charitable lead trust, and Penn State's going to be the income beneficiary. They're going to get income every year for the next 20 years while this donor is still working in a high income tax bracket. They needed a tax deduction. And then later, when the retirement years, they're going to be the beneficiary of that trust. So the charity takes the lead, and then the donor can have some income benefit back from that trust, or heirs can. So charity lead, charity remainder, two different types of trusts.
Yeah, and another way to think about this is the legal term is a split interest gift. So what that means is if you take a whole, just think of like a pizza, and if you do one of these trusts, you're going to end up with some of the pieces of pizza, and the charity's going to end up with the rest of the pizza. So they split that out. And what the government does is they use a calculation using interest rates. And even though the charity is not going to get the money until future years, whether it's a lead or a remainder trust, that's a future interest, right? That's something the charity will get in the future. The government allows you to take a current income tax deduction in the year that you set this trust up. So this is really a powerful strategy where you can, instead of taking this charitable deduction year over year over year, you front load the charitable deduction. And I will say many clients use this. There are a lot of clients we've helped out in the tech space who have used this when they have big liquidity events with maybe with company stock. So this is something that is a very powerful strategy. I would say that attorneys and advisors don't know enough about this. Christina,
Correct.
on it. So, but a lot of people don't know enough about this, and it really is a shame because these can be very powerful tools. And before we started this webinar, we were saying how we're going to be doing a kind of an in-depth dive on the different methods of using these trusts to really leverage their capability to deliver more wealth to you, the charities, and your families, and less to the government. I mean, that's kind of what it's all about. I mean, I don't know about you. I'd rather give it to a charity than just blindly turn it over to the government.
Yep.
Annuity.
Yeah, charitable gift annuities. Charitable gift annuities are, giving a particular asset. You could give, $100,000 or, however much of a gift to a charity. In exchange, you're giving up complete control in exchange for an annuity of an income stream, a lifetime or a particular term. Could be a 10-year, could be a 20-year, could be a lifetime, that you're going to get some income back from that gift over your lifetime. And then the remainder, or if you were to pass away, goes to the charity. So I'd say that those are probably far less utilized in today's day and age. There's just more advanced tools, but that's a very simple, it's been around for a long, long time, just not as commonly utilized. But donor advised funds, charitable trusts, very highly utilized, both for income tax and estate tax mitigation. Qualified charitable distributions are highly utilized in our firm. I would say highly, highly utilized, especially since we've gone to a standard deduction that is so high, to where some clients might be giving $18,000, $20,000 a year, which is a significant gift to charity for some clients. And the standard deduction is higher. So they're not getting the benefit on their itemized deduction. They're not getting that tax benefit in that earlier illustration that we did. And then clients get to a certain age where they have required minimum distributions. Required minimum distributions under the Secure Act 2.0 now are required at 72 at the earliest. And if you're born 1960 or later, those required distributions start at age 75. And that's a distribution you're required to take out of your 401ks, IRAs, all of those assets that you've taken a deduction on in deferred income. So as you're required to take out this money out of those plans and pay taxes on them, what you can do is say, rather than receiving that from my IRA, let's just say that my requirement is $100,000. Rather than taking my $100,000 I'm required to take out of my IRA or my 401k and then paying income tax on it and then giving money to charity, which I might not get the deduction for because I am only taking the standard deduction, you can say, don't give me the full 100. Send 20 directly to the charity of my choice, as long as it's a public charity. And if it goes to a public charity, then that $80,000 that you receive is the only income tax you're paying. And $20,000 goes right off the top directly to charity. And so you're not taxed on that full 100, but the IRS says that that satisfies the requirement. So if your requirement is to take 100 and you designate, you fill up that full $100 basket, as long as it goes, some of it goes to charity and some of it goes to you, it can't exceed 100,000. So that's the trick, is it can't exceed 100,000. And so if your required minimum distribution is 200,000, the IRS doesn't let you give it all away. The IRS says you're limited to $100,000 per IRA account holder. So if it's a married couple, spouse one can gift 100,000 of their RMD. Spouse two can gift 100,000. It's just 100,000 per account owner. And then the only other caveat to that is it cannot go to a donor advised fund. It has to go directly to a charity. And that can actually start at age 70 and a half. So even though your required distribution age is not till 72 or 75, you can do charitable qualified distributions, what we call QCDs, qualified charitable distributions, from an IRA at age 70 and a half, and excuse me, no age requirement on an inherited IRA. So Jim, if you were to inherit an IRA, you could do a distribution from that.
Michelle has a question. Do the funds in a donor advised fund get taxed? No. When they're in the donor advised fund, these are tax-free zones. So you can buy and sell and think it's not getting taxed. So the gain, the income, not getting taxed. Kathy asks, what's a typical gift size range for CRT or charitable lead trust versus gift annuity? Thanks. I would say that the gift annuities, a lot of people will do 100,000 or 50,000 or 150. Charitable trust, you have an attorney involved. I think probably it's 500, 500,000 to $1 million, something like that. They typically are bigger. Now, does that mean you could do a charitable trust with 200,000? Yes. And there is a use case, and we will cover this in the future. There is a use case for putting in very low valued assets that you kind of know are going to get, you might get founder stock in a company, right? In a startup, it might make sense to fund that trust with that stock, knowing that it might go up, right? So there is a use case for that, but typically it's when those assets will be in the several $100,000 range, and the gift annuity is a bit smaller. Donor advised fund, you want to kind of walk
yeah, so I know we kind of spoke about this, but here's kind of a quick chart that just shows, what you would do is you would create that donor advised fund. You don't have to create a donor advised fund that you manage. A lot of clients will, if they know that they want to make a gift, that they want to invest those funds and then, maybe let them accumulate and do a little giving over time, or maybe they're bunching and they don't want to give all of that gift in 1 year. Or you can give it to a community organized donor advised fund or a community foundation that has a donor advised fund. And that might be a community foundation that is one that you support. They have causes that are aligned with your goals and values. And so you can contribute securities, you can contribute cash. So you can give appreciated stock, and then it could be invested for growth, and then making gifts over time or future gifts. And you can also have this be something that we talk a lot about, making sure in your trust that your kids or your heirs or family members have the ability to still sit around the table at Thanksgiving together and have peace. And as long as you have a properly done estate plan, they might be able to still do that. But another way to help keep the glue of what might be your charitable values is to have a donor advised fund that your next generation will still manage, or your heirs or loved ones, that they have to get together and sit at the Thanksgiving table every year and figure out, okay, we've got this donor advised fund. We want to make sure that we're doing some giving this year. What do we want to make sure we're giving to?
Yeah, and the alternative, I guess, the alternative would be to set up a private foundation or your own public charity. But that there's care and feeding, there's headspace there, you have to deal with it. And for many people, they go, you know what, I want to commit this money to charity over kind of a shorter time period and involve the family. And this can be great. And it's interesting you mentioned getting together for Thanksgiving, Christina. I was recently on the phone with a larger family, 5 kids, and a couple were getting disinherited. And I asked the kids, well, do you guys get together for Thanksgiving? Yeah, we all 5 do. So, it's very important when you do estate planning to think about your legacy. So when you leave this earth and do you want your family to get along or not? I mean, I think both are probably valid in certain circumstances, but that really is sort of the Thanksgiving dinner test. And, where Thanksgiving's coming up, and I can't believe it, just a few weeks from the time that we're presenting here.
So I think we touched on this, and this is something that comes directly out of the IRA. So again, that's one of the things that we do with our clients is analyze how they're doing their charitable giving and are they getting the right deductions for it. So QCDs are an important factor in that. Again, charitable. Go ahead.
Let me speak on charitable remainder trust. So a lot of times when you talk to people, they'll say, "Oh, you put money in and you take 5% out." It's because with the charitable remainder trust, that is the minimum you must take out. You can also have a zeroed out charitable remainder trust, which is fundamentally a tax deferral strategy where you get less of a charitable deduction. You have to get 10%, right? 10% has to go to the charity. But this is fundamentally a tax deferral strategy. So it's almost like an alternative to an installment sale. A charitable remainder trust you could do for like a term of 10 years. You spread out your gain over 10 years. You take advantage of the lower income tax brackets. If you have a really big liquidity event in 1 year, and then at the end of 10 years, the interest goes to charity. And you can put pretty much anything other than S Corp shares. So I don't want to, beat this drum, but a lot of people reach out to us and they say, "Hey, I've got a small business. I'm selling for $10 million. I want to set up a charitable trust to defer the taxes." You can't do that with S Corp shares. But the idea here is when you put those assets in the charitable trust sells those assets. You can't have already made your deal, right? You can't have said, "Oh yeah, I'm going to sell my S Corp business or my partnership business." The charitable trust has to be the seller on this. It just doesn't work if you're coming in at the 11th hour. So when the person who's giving the money, that person is entitled to an income stream. That can actually be assigned to another person, by the way. That income stream can be assigned at a discounted valuation. So many times clients will set up a charitable trust and the beneficiary is their children. Okay, not even the client. So that's one strategy to minimize wealth transfer taxes. But again, the minimum is 5%. And that's both for charitable remainder unit trust and charitable remainder annuity trust. Now, what is the difference? A unit trust lasts for a lifetime. It can be for a period certain, but it's related to your lifetime. And so the U is open. And this is the real big difference. The U is open, which means you can add assets to your charitable trust. So you set up a charitable remainder unit trust. You put $100,000 in stock this year. You put $100,000 in stock next year. Another $100,000 in stock the following year. You're going to get back a unit trust amount, which is basically a percentage, whatever this value of the account is on this date in a given year or given time of year, you're going to get a 5% payout. A charitable remainder annuity trust is an A, it's closed. You cannot add money. So a charitable remainder annuity trust, you set it up, you put $100,000 in, well, you probably put more than 100, but you put $100,000 in, you can't add any more money. It's just the basic architecture of these two trusts. That is the big difference between the annuity and the unit trust. So the unit trust is open, the U is open, you can add money to it, and the charitable remainder annuity trust is closed. You cannot put that in there. Assets that are difficult to value, that presents its own puzzle because on a unit trust, you have to value this every year. And if you've ever gone through a valuation of an asset, it's kind of a pain to have to value that every year. So that may not be as workable. An annuity trust might be a better alternative, right? On an asset that's difficult to value. So you want to walk through this example of Bob and Sue?
Yeah, this is just a good example. This is an example, Bob and Sue, 65 years old. We also do this with a lot of clients that might have RSUs that are highly appreciated, or in the tech space that might have had, tech stock that was, highly, highly appreciated. They've got so much of it as part of their portfolio and in a concentrated position. And they're going, we want to sell it, but we don't want to pay the taxes. But they still kind of want to have a benefit from it. And so this is that way that we can, rather than paying taxes, we could put some of it into a Crut is what we call it. So in this particular example, we've got $1 million of appreciated stock. We can create a Crut. And then what happens is, let's just say that particular XYZ stock goes into the Crut, could have a very low cost basis. Maybe they paid $100,000 for it. It's worth $1 million today. $900,000 gain. And so in the Crut, if we create this legal document, this trust, we put an account together for the Crut. We put the stock in the Crut. We don't sell it until it's in the Crut vehicle. Then there's no income tax triggered to the donor at the time of sale. It stays inside this trust. And what happens is the tax takes place over time. So let's just say that $1 million, we now sell it, we invest in 50 other stocks as opposed to owning one, get it to be a more diversified portfolio. And then that $1 million is paying Bob and Sue 5% a year. So in this particular example, $50,000 at the beginning. But let's just say that account is growing at an 8% growth rate. So the next year, the December 31st value is $1,080,000. I'm just saying not, or $1,030,000 because they've taken 50 out. So at 8% growth, they've taken 5% out. The value at the end of the year, the next year is $1,030,000. And then they can take 5% off that value. So as long as the growth is continuing to grow and the assets that are in the CRUT, you're going to take 5% each year of the prior year end value. And so it's a way to have a little bit of an inflation adjustment on an income stream to the donor. And so then as that income is coming out, if it was long-term capital gains stock that was originally donated, you're going to pay tax on that as you're getting income out of the trust. So, and then there's some nuances with how that's taxed as it comes out. But with, for all simplicity purposes, you're not paying the tax at the time of sale. Rather than paying a huge tax bill, you're paying income tax as it comes out, but you're also getting a tax deduction when it goes into the trust. So in this particular example, at their age and at the current interest rate environment of 5.4%, which is based on a IRS published 75/20 rate, it's how they dictate how the gifts and deductions work. This gave them an income tax deduction. They were able to sell it without having a capital gain, get an income benefit for it for the rest of their life, and then have money at the end of the term go to charity.
That's great. Otherwise, I mean, the alternative is to, pay, I don't know, $300,000-$400,000 in capital gains tax.
Yeah. And then, in this environment, we're doing a lot more charitable remainder trusts. And the reason why I say in this environment is this is a high interest rate environment. So the higher the interest rate environment, the better the income tax deduction is for the donor. And so a charitable remainder trust is better in a high interest rate environment for the donor. A charitable lead trust is better in a low interest rate environment for the donor.
It's amazing how that, when you're talking about this, we've just had this huge change. The 75/20 rate that you mentioned, what is 5.4%. It was like 0.15%. It was 0.15% not that long ago. And these interest rates have gone up like 50x or 35x, whatever they are. And it's really shifted the planning strategies. So people used to do a lot of grats. Well, now grats not looking as good. I mean, it's still a good strategy, which is kind of outside of the scope of what we're talking about. But bear in mind, these planning strategies are heavily dependent on the interest rate environment. So another great interest rate play is the qualified personal residence trust. So this is for a more affluent person. We cover this in other webinars, but bear in mind that it's very important as a practitioner, if you're a lawyer watching this or a CPA or financial advisor, it's very important to really factor in the change in the interest rate environment, because it really kind of nudges us to set down some planning strategies that we might have done 2 or 3 years ago and pick up some other ones that we haven't done.
Yeah, we're doing a lot of strategies we haven't done in years. And I mean, we even did a lot of CLATs 2-3 years ago. In 2020, we did a lot of CLATs. Interest rates were much lower then. We're doing a lot more CRUTs today. So, but just kind of to go back to a CLAT and what is a charitable lead trust. I say a CLAT because a CLAT is more common than you use a unit trust a lot more commonly on a charitable remainder type of trust. You use an annuity trust a lot more commonly on a lead trust. But a charitable lead trust, this is a great way to get money out of your estate for estate tax purposes and give to some charity while you're living. So doing your giving while you're living, but not necessarily having money go out of your estate out of your estate for tax purposes, but not completely leaving your estate forever for your heirs. So this is a way to set up an irrevocable trust, transfer cash or assets, and get a charitable deduction. The charity can get an income stream. And then at the end of the term, the assets can go to your heirs and they're outside of your estate for estate tax. So if those assets, let's just say, are growing at 6 to 8% a year, you might be giving 2 to 3% a year to charity for a period of 20 to 30 years. And at the end of the term, whatever that pie has grown to can go into an irrevocable trust for the benefit of your heirs at the end of that term.
The three-legged stool. This is very, very important. A stool with two legs falls over. A stool with one leg, I guess, is a unistool. I don't know, a unicycle or something. I don't know. But this is really important. It's very important to have these three people. And I will tell you, CPAs, good CPAs are getting harder and harder to find. I know a lot of my clients, they say my CPA is retiring. No one's picking up my 1040. Newsflash, nobody wants to do 1040s anymore. If you are relying for years and years and years on a CPA doing your individual income tax return, I'm just seeing that trend has shifted, and it's increasingly harder to find them. It used to be 20 years ago, 10 years ago, CPAs did a fair amount of financial advisory work, meaning a lot of what we're talking about here, we might have had a CPA on this webinar 20 years ago. But what's happened is the CPA population is starting to shrink. Well, it's shrinking significantly. They're doing less 1040s, and that financial planning component has shifted to the financial services industry. Frankly, lawyers are too expensive. I mean, I'm too expensive to sit down and do financial planning with a client. That's really within the purview of Christina Lindsay, and it used to be with the CPA. So if you're feeling a little frustrated that your CPA's, sort of retired, and maybe your financial advisor's not where that he or she should be in their knowledge, I'm seeing a trend to going from big wirehouses to independent advisory. And then these independent advisory professionals like Christina are having the laboring oar on the financial planning aspect, which is, running the math and then checking in with the CPA to essentially check the math. But Christina, you do a tremendous job for clients, mutual clients. You're my own financial advisor, so you're doing a great job, and I'm really happy that you were able to join us here today.
Thank you. And we do have a team. So we, the nice thing is I'm here talking, and Jim, you've got a great team. I've worked with your team of attorneys for many years, and there's collaboration between the two, which is the key thing here, is collaboration, communication, making sure that there's the right strategy for the right client. And I have a team. All of my team of partners and advisors, they're all certified financial planners. We all have advanced planning and estate planning credentials. And Shannon and I in the office specifically focused on charitable planning within advanced planning. And so that was kind of our core competency as far as what we decided to focus on in our advanced planning certifications and estate planning knowledge is charitable giving, because it is a big part of clients' goals, values, mitigating estate tax and income tax. So this is a very coordinated strategy where it does involve complex trusts. So then we do need to engage your team at Cunningham to create those trust vehicles as well.
All right, so we're kind of at the end of our material here. We're going to wrap it up. If you have any questions, go ahead and type those into the Q&A, and then we will answer those. We have offices in the Cunningham Legal has offices in Northern and Southern California. I will be in Pasadena tomorrow doing a live event webinar in our Pasadena office at 10 a.m. and 2 p.m. We had to add another date, and that is in sort of on the eastern side of Pasadena. We'll be talking about some estate planning concepts. These are the phone numbers for Ascent and Cunningham Legal. This slide will pop up here in a minute. If you want to take a picture of that with your phone, feel free to do so, or screenshot it, but this will pop up again next week, and you might have already seen this because this is getting on YouTube, and I haven't given this yet, but by the time you see this video, I might have already given this webinar. I don't know if you're watching on YouTube, but this is very near and dear to many of our clients' hearts, which is the real estate. And this is the ultimate guide for using LLCs for real estate investing. So very, very important that you understand the basics and a little bit of advanced stuff, but there's some real, blocking and tackling when it comes to LLCs and how to do it and how not to do it. And we'll cover that next week. Go ahead and subscribe to our YouTube channel if you are watching this on YouTube. And if you're watching it live, go on YouTube and subscribe. So it's a great opportunity to keep the learning going. And so we will go over some questions here. We've got our phone numbers here. Feel free to call.
I will say one thing we didn't mention is Giving Tuesday. What we wanted to do this webinar in advance of is Giving Tuesday, which is November 28th. And that's kind of become a big theme for a lot of charities as they enter the holiday season surrounding Thanksgiving and thinking about thanks and giving and being thankful. Giving Tuesday is November 28th this year. And that's when a lot of charities do their drive to raise funds. They might have matching, additional donors that have agreed to do matching dollars for the charity of your cause. So if you're looking to maximize your impact gift in this year, whether it be a QCD or other things, giving on Giving Tuesday or around Giving Tuesday, look for charities that are looking to maximize those dollars.
I want to thank you for joining us, Christina. And if you're watching this on YouTube, just keep watching, because magically another video is going to roll right after this one. So thanks for watching.